This is regarding to Fed fund rate, okay? Means remember you saw those Fed when they have the format meeting, the open market operation, open market committee, when they have meeting, and they will make decision about what's the Fed fund rate should be. Okay, they say increase the 25 basis point or reduce 25 basis point, or what's the monetary policy, and people are watching closely, and then that's how people are pricing in the market condition in the future. So that's why it's very important. Okay, so it is tools of a monetary policy, what the Fed can do, what the Fed can use the tools. Okay, so this is like I said, this is the final touch on the conclusion about how they working on those Fed fund rate result. You will see very funny is how they control. You're looking at Wall Street Journal at the market data and looking at the interest rate. That's a piece section on top. The first interest rate they mentioned that piece, it is Fed fund rate target. It's target rate, okay? So today we'll see why it's target. And it's not one single number, it's a range. Like right now it's 0 to 0.25% that is target, okay? So that's, you will see the story, very, very important piece, okay? So let's look at it starting from beginning. What's the tool, okay, what the monetary policy can do, okay? Let's see this. So first of all, market for reserves and the Fed fund rates. See, that's what we learned, Fed fund rate now come out. So first of all is, remember, a recap. What do we learn reserve? Remember, what's the reserve? Do you remember what's the reserve? Anybody? Thank you. Yes, it is. Okay. So banking, when you deposit money, okay, the banking have to, that's required reserve, put the money in the Fed. Okay. That's called required reserve. But Fed also, the banking also is, like a human being, like a corporation. They have a choice to choose. They can choose more money deposited in the Fed. Okay. That's the excess reserve. Or do not have to put actual, right? They have this kind of freedom, okay, to choose. So we learned that ample reserve, how banking very sound, safe. But too much reserve, then banking don't make money. Remember, we learned those, okay? So that's right now we're gonna do is that we're gonna do analysis market for the reserve. Means supply demanding, right? Market demanding more or less. So Fed can use that kind of reserve to control the interest rate, okay? Remember, Fed fund rate, Fed funds rate, very, very important. It's the fundamental interest rate. Every other interest rate is starting from this one. So this one, if we go going higher, everyone going higher. If this one going down, everyone gonna follow. So because it's the foundation of interest rate, okay? That's why it's so important. All right, so now you know we talk about reserve and also talk about how we get the Fed fund rate, okay? So now we use the supply demanding that the tool, okay, how to analysis on the reserve, where we'll talk about supply and demanding reserve, okay? So you already know that the Fed is a banks of a bank. So that means those reserves moving around, the Fed can, because Fed is the bank, so Fed can influential about this reserve, okay? So that's another thing. So what happens to the maturity of, to the quantity of the reserves? Banking wanted more or less. So if this is something changes, then will be a factor to this reserve, okay? So that's why I say, what happens to the quantity of the reserve? No, we haven't recorded a whole semester. We didn't choose to record, okay? So just follow. We don't have record. I know you guys, see here, this course right now, okay? Right now, you guys facing the final now. So your timing is really, really tight because everybody wanted, all professors wanted your time. So this course is like this. People interested on the money, on the banking, on the Fed, on the policy decision. You wanted to know how they affect the market. And this course, you'll be interested on those, you will be follow. But people, if you learn only for exam and just follow, for the credit, so then you didn't follow the class, then what happened? Then you have to just like you read a book, right? Self-taught yourself because you didn't spend that much time follow class. If follow class, you have fun, and also you don't need to read it too much because you already follow a lot. But if you don't, you can recap yourself, recover from the missing, read a book, okay? And then you have homework, right? Homework is very good. Homework, it is practice, punch you, especially for junior. I mentioned this day one. For junior student, you don't have that sense about market, what the Fed is doing. I never heard about this Fed foundry. Those people, if you're too junior on this market, you maybe need to read a lot, not only book. Also Wall Street Journal, Financial Times. Okay, we mentioned this day one, okay? So recording, not recording is not a big deal because key point is not follow, you don't interesting, you won't learn anything, feel fun part anyway. So however, we don't, and you're going to be read a book more, okay? So here's the final touch, like I say. It is a supply demanding on this reserve. Remember, banking put on a reserve banking like a human being. They're gonna be based on what they like. They put more or less reserve. Okay, so based on economic condition, today we're showing you how we're deriving this curve. Okay, so that's the one thing. So we're trying to say is when we do the economic equilibrium, supply demanding, you always have holding everything else constant. All right, so let's see what's happening to the Fed fund rate change. I'll just, it's common sense, okay? Remember, it's common sense, follow. Just say, everything else is constant, then just see as the Fed fund rate changed, what happened to demand on the reserve, okay? Demand or supply on this quantity of the reserve. Okay, we're going to do that. What happened, all right? Next one. So banking can choose more reserve, so excess reserve. We know that accessory, remember the banking, we have that example. When banking have ample reserve, the banking survived, remember? So here trying to tell you, accessory reserve are insurance, right? Remember that's why the ample reserve that banking survived. The other one meet the requirement on reserve, but the bankrupt, okay? So you remember that chapter. So therefore, this is trying to tell you, excess reserve are insurance because remember, it is protect the bank. So against the deposit outflow. So that's what we, this sentence we learned it already, okay? So now follow me, okay? Very important. I will argue about this, okay? See, cost of holding this is the interest rate. I hope you understand this, okay? I want to ask you a question here. So if what cost of holding this is the interest rate that could have been earning minus the interest rate is paid on this excess return. Let me ask you a question. I'm just, before I ask you, let me draw the chart again, okay? Here. The Fed. And then we have a couple bank. Okay. It's reserve for Banking of America, reserve for Citigroup, reserve JP Morgan, okay? Here we try to analysis to say, okay, banking can put a accessory reserve beyond the required reserve you have to put it there. Then they put more here, accessory reserve. But JP Morgan, if they put more reserve, must be have attractive. They want to put it there. But remember, you are here, okay? You represent all of us, all of the people who borrowing money from JP Morgan. So if JP Morgan, they put the money more in here, then less lending to you, then society will have less money, okay? That's the logic there. So now we want to analyze this reserve here. So now what we say is we have here the Fed give the interest rate, put interest. Remember we learned that chapter, the Fed decided this interest rate called ER, okay? I do this way. Okay, so that means well, the Fed pay interest rate higher or lower depend on what the Fed make decision. Then the JP Morgan will judge it. Okay, remember I'm drawing this chart too. The banking borrow lending to each other. So JP Morgan, let's say JP Morgan. JP Morgan, here's I did ask it last time. If banking lending borrowing each other, what's this interest rate?
Oh, the federal funds rate?
Yeah, so that's Fed fund rate. Very good, very important here, okay? So I do this R, okay, R, Fed fund rate, okay? Remember, very important here. So see, this is the one interest rate, it says reserve. So Fed gave the interest rate here. So if JP Morgan judge it by this one and this one, which one's a good deal? Okay, so for example, let me ask you. So if the Fed required the reserve Fed gave 4%, okay, remember I'm exaggerating. It means like give you some number, just a hypothetical, okay? If they Fed pay the excess reserve 4% interest rate and pay this Fed fund rate, okay? Fed fund rate means banking lending to each other. It is the market, okay? Means today the market environment. If it's 3%, okay? Let's say JP Morgan right now need the money, okay? In this case, JP Morgan will borrow, you know what, I don't say borrow, I have to have discount rate again. I have to put another one more rate, okay? Because we're going to use it anyway. So another one, discount rate, okay? So I'm going to confuse you very soon. Okay, you see this one. Let me ask you, who make decision of discount rate? Who make this? Very good, very good. Yeah, thank you. You guys are good, very good. So, okay, we have so many things here, okay? Don't be confused. Let me ask you, assuming you are CEO of JP Morgan, okay? At this moment, if JP Morgan looking at this rate in the market right now, do they want to lending money to, what you want to say, okay? If Citigroup want to borrow money from JP Morgan, okay, see what the JP Morgan going to do. You're a CEO, okay? At this point in time, Citigroup want to borrow money from you. You are JP Morgan CEO. And are you going to lending money to Citigroup, or you want to put money in the reserve? Let me say again, okay? You're CEO JP Morgan. Based on this interest rate environment setup, are you going to lending money to Citigroup, or you're going to put money in the excess reserve?
You will put money in reserves.
Thank you. Thank you. Very good. All right. That's the truth. Okay. That's the truth. Okay. So that means you prefer put the money here. Don't lending to each other. So the bank in American do the same thing. They don't lending because here pay good deal. Like I said, corporation just like a human being. It's good for them. They choose always favor to them. So they will put the money in here. So reserve will be more and more here. Okay. Then nobody lending here because they put the money here, parking here. So that's one way you can see demanding supply on this reserve can influence of the market overall. Remember money supply, and then monetary base can be mushroom based on the multiplier. We learned from last chapter, whole story, they can create this piece too, okay? They can use this piece control. So that's what we're gonna use that to derive this curve, okay, very soon. And that's what I mean, okay? So you can see now you know cost. See, I want you to read this piece to tell me what do you recap this guy. This IER is my RER, okay? Just interest rate paid reserve. Anybody understand what I mean here? Give it a shot. Why don't you try say what I mean?
Yeah,
So
can you repeat the question?
No, just here, no question. Just tell me this bullet what I mean.
Oh, the bullet point.
Just this one.
so the cost of holding reserves is like the opportunity cost, meaning that if you hold reserves, you cannot lend that money out because they're in reserves. Therefore, you're not earning the interest on them, but you are still getting interest from the Fed. So the cost of holding the reserves will be the difference between those interests.
Okay, so here's
Can I try this, Professor?
go ahead.
Can I say it's the Fed funds rate minus the reserve rate? Would that be correct?
No, let me mention because here that's why I'm asking. Okay, good for your thinking. Okay, see they say it's holding this is the interest rate. So here's the case. Okay, the interest rate referring to what here refer to interest rate. This one.
Oh, so that interest
Reserves.
is what you would earn on deposits.
Okay.
Yeah, no, what you would earn on loans. Sorry, when you
Okay.
lend out. Yeah.
Market interest rate, right? Very good. Yes.
Yeah.
So that means in the market that said 3-year rate or 5-year rate in the market that interest rate. If this interest rate, let's say, if it's 5%, okay, just hypothetical, market interest rate is 5%. JP Morgan knows, and then the Fed pay ER. The IER means excess rate is 2%. I'm go here. I go there to do that. See. JP Morgan, so okay, market here, it's not Fed fund rate now, another interest rate come out, see? Another interest, market interest rate, I say 5%. What I mean, market, just like I say, it's right now, we know each individual discount rate, the accessory rate, and Fed fund rate, but this also have market interest rate, right? You can say it's a 5-year interest rate, for example, in the market, or make a loan, 5-year loan, or 10-year loan, whatever. So I say 5-year interest rate right now in the market trading at 5%. Okay, so another interest rate 5-year. That word that bullet say is that interest rate is this one. Means in the market, if interest rate is 5%, let's say JP Morgan can make a loan to your student loan, it's 5%. All right. So if a reserve will pay interest 4%, JP Morgan will be put money here or put lending money to you?
To us.
Yes, exactly. So therefore, JP Morgan will be lending you 5%, not putting, so they're putting out this money from here. They don't want to park in there, make 4%, but they can lend you make 5%. So then they will take more money lending loan to society, to you and me. So why? Because JP Morgan opportunity cost holding money in here 4% rather than lending to you 5%. This cost holding in here is what percentage? Cost holding money in here excess return, not lending to you. What's the percentage?
1%.
Yeah, exactly. That's what they said there. Okay, so 1%. So 5% minus 4%. That's your cost. Why? Let me say it again. That's what's actually your opportunity cost. Okay, let me answer. We'll talk about that. Let's just finish this piece. Okay, you see how many interest rate right now? Because right now you know now it is this excess reserve. They pay interest rate. The Fed make decision. Remember, board director they make decision, and this is the discount rate. Remember from discount window. Also, they make a decision. So member bank can borrow from this discount window, borrow this money. We'll talk about this. Okay. So then you have banking lending to each other is the Fed fund raised here. Okay, they're lending to each other. It's not the Fed, it's named called Fed fund rate, but it's really banking lending each other for the money put in here. So that's JP Morgan need the money. They borrow from other banking and just for this reserve. Okay, so that's why it is called Fed fund rate, but it's not a Fed control that way. Okay, but we will see. Watch it. So now we have also banking can make a loan lending the money and can make a 5%. That's interest rate. This market interest rate fluctuated based on economic condition. Okay, so this is changing all the time. So this 5% now. So banking, JP Morgan, banking business, right? Lending loan, lending money. So JP Morgan, if it can make a 5%, they won't put the actual money in here to make a 4%. Okay, they won't be. Nobody will do it. Therefore, we said that holding money in here rather than lending out, that's the opportunity cost. The cost is 1%. If you just do not change your position, you just continue holding there. Market is 5%, but you still put a 4% into money in there, earning 4%, you lost. So that's your will be opportunity cost, or cost is your 1%. That's what I mean there. Okay. So very soon we'll talk about what I mean opportunity cost. Okay. So at least we finish this piece. Okay. That's what I mean. So cost of holding this is the interest rate, the 5% that could be earned minus interest rate you paid put on the excessive reserve. That's the 4%. So that's why it is. Okay. So we've done this. Very soon we're going to be opportunity cost. Okay. Let's see. Just follow me. So we need to figure out the demand curve. Okay. So remember, the reserve can be fluctuated. Banking can change your mind, put anywhere. So then demand, we want to gather the demand curve. So let's see what happened. Okay. So first, when they tell you the story, they say this since the 2008, financial crisis, right? So Fed had paid interest on reserve. So at a level that is set at a fixed amount below Fed fund rate. Good. At least we know now. That's why I put a Fed fund rate. Remember? So you can see that. So below Fed fund rate. So you can see means what? Which one below? Which one? See, pay interest on reserve. So let me ask you a question based on that. Okay, follow me. Okay, don't be asleep. So what they tell you there is, so this is the Fed fund rate, our Fed fund rate. So something higher than Fed fund rate, which one? Won't be below means higher. It's higher. So which rate they trying to say? I hope you follow me. Let's see.
Higher than the 4% RER.
So after 2000, okay. So the okay, watch it.
Reserves.
Okay, so yeah, so let's continue. Oh, just hold on. Since 2008, the Fed has to pay interest on reserve at the level is set at a fixed amount below Fed fund rate. Okay, I'm typing this one. Okay, so which rate that one is lower than Fed fund rate? Which one? I want
The reserves,
3%.
the 4%.
Wait, that has
yes.
to be lower than the Fed fund rate, right?
Yes. So lower than Fed fund rate. Okay, so that means who I ask you, so this guy, right? Excessive reserve, right? Must be not higher, means lower than our FFR, Fed fund rate. Okay, so first thing we know now, since 2008, Fed starting pay interest rate and then make this excessive reserve lower than Fed fund rate. Do I make it right for you? You agree?
Yes.
Okay, because follow that sentence. Okay, very good, because we're going to use it. Okay, that's the first one. Okay, see, below Fed fund rate. So that means the excessive reserve, that interest they paid lower than Fed fund rate. Okay, we find out the bottom. You will see very soon. Now watching. So when the Fed fund rate is above the rate paid excessive reserve, we just know that. Okay, above. So Fed fund rate larger than the excessive reserve rate. Okay, and that at that moment. Okay, so this is twist the word. Okay, so as the Fed fund rate decreased, so we had to figure out this. What do you mean opportunity cost anyway? What's that mean, opportunity cost?
The next best alternative.
Less of the opportunity.
Next best alternative.
Give me an example. Yes. Let's use example. What do you mean opportunity cost? Can be anything. Okay, don't have to be this here, but just say, oh, you lose the opportunity cost.
Yeah, the next best available option.
Okay, yes. So can you make a full story? The story say, oh, this is the story. It is
Okay.
opportunity cost.
Oh, okay.
Mhm.
Student income versus wages. Like, sorry, school fees versus wages.
Okay.
Yeah.
Okay.
If you go into school, you have to pay fees, but you could
Yeah.
be earning wages instead of paying fees.
Good, good. Okay, very good. Okay, it is like that story. You can do either way, right? Say you pay the tuition, but you go to the college. Okay, but your same high school classmate, that person want to work, make money right now. But you have a college degree in the future, you will get a high pay. You're gonna promote. You're gonna be doing whatever. Now, your classmate may be missing all those opportunity costs because depend, right? Like I say, is if he think right now is just the best moment make money, in the future they don't pay well, or in the future inflation coming, and yeah, I make the money, but you make a lot of money, but it's all paper, so whatever. But anyway, like I say, it is do something, give up something else. That is opportunity cost. Okay, let's see, we give up here. What do we give up here? Okay, so opportunity cost of holding excess reserve false. I want you read this piece, okay? Here's, I want to join you, read that piece and then see whether you get it. What I mean holding excess reserve, this opportunity cost dropped. Okay, so let me draw the chart first, then go back again. Okay, I want you see this chart. So what are they trying to say is, the first thing is they tell you, it is this one. Okay, one is one interest rate. Okay, so this vertical, it is Fed fund rate. Okay, Fed fund rate here. Okay, that's the Fed vertical. I'm tapping here. So vertical is the Fed fund rate, R Fed fund rate. Okay, so you remember, see, RE, so required reserve rate. So Fed fund rate above, what is that? Okay, it's above means, so this interest rate here, this one is RER, okay? So means the reserve, remember the reserve, excess reserve, they pay interest, that's the Fed make decision there. So that's interest level, okay? So they say, well, Fed fund rate not below, never below ER, okay, RER, so never, so they're above this level. If above this level, not done yet, then they say something, okay, watching, what they say? They say is watching. Say when the Fed fund rate is above the excess reserve rate, we did that, okay? Now, as the Fed fund rate decreased, okay, and what happened? You tell me, let's go there again. So that's what drawing the decrease, okay? So when Fed fund rate, this is Fed fund rate, if it dropped, okay, go down this level. So that means this rate is lower, okay? So then they mention about opportunity cost. So that said before it's like this. Now this one, not 3%, now becoming 2% now. Okay, just think about that way. So what is the opportunity cost here is, I want you to figure out here. So then what? The opportunity cost of holding excess reserve, okay, dropped. You agree?
Yeah.
And then quantity of the reserve demand rise. You agree?
Yes.
Okay,
Yes.
good. So you follow. Very good. Okay. You see? So what happened like this? If interest rate banking lending to each other interest rate, then JP Morgan very happy. It means, wow, now I make a 4% now. I make double than market now. So that means because they're holding this reserve here, then they will be one more of a reserve because the interest rate attractive in here. All right. So that means what? Banking will put more before put this amount reserve. Banking want to put more. You agree? Put more reserve. You agree? So that's yeah. So if at this interest level, put this amount, but now this interest to 2%. Now reserve they want more more. This is quantity. Okay, so this is quantity here. This is interest rate. So when Fed fund rate lower, you can see. You see, I got second point. So more, the JP Morgan put more money here. So reserve quantity for reserve increased. So from here to here, I said before is 1 billion. Okay, after this Fed fund rate dropped, see dropped, then you can see banking very happy parking money here. So JP Morgan will be put more money here. So then this is 2 billion. All right.
Professor.
See? Good.
Professor.
Go ahead.
Oh, sorry. So in this example, so in initially we saw that if the RER is 4% and the federal fund rate is 3%, the opportunity cost is 1.
Well,
Right?
no. Opportunity cost is 1 is 5 market. This is not compared to this one. Opportunity cost is compared this money put in here or lending out to the society. Okay, I know that's why we say so many interest rate here, confusing, and that's the whole point. Why so many interest rate? 5% is lending to the market, to you as a student loan, for example, is a 5%. So banking, JP Morgan, like a human being, they can lending to you, or they can put the money parking here, make a 4%. So
Right.
then, yeah. So then, if they put the money parking here for 4%. But they can lend you make a 5%. So then if they all put money here, that means they lose 1%. That's opportunity cost. They should make a 1% more lending in the society. And that's why it's opportunity cost for the banking, didn't lending to you, just holding money for safe parking there. Okay, very good question, because so
the
many interest
opportunity
rate.
cost, so the opportunity cost has nothing to do with the federal fund rate.
No, yeah, exactly, nothing. Yeah, because the federal fund rate is, remember why, let me repeat again. Federal fund rate, why call federal fund rate? Okay, why just don't say market banking lending to each other interest rate? Because JP Morgan, let's say JP Morgan borrow money from Citigroup is 3%, but this money is for parking in here. Remember borrowing reserve? So this money is JP Morgan like this. So remember, they all have account. So Citigroup, JP Morgan say, Citigroup, I want to borrow money. And then they find out it's 3%. And then JP Morgan just tell Fed, say, you know, I borrow money from Citigroup, just transfer money to my account. So Fed just transfer there, because the purpose of borrow money to each other, this money is for here. That's why for reserve. If today JP Morgan short of money on the reserve, they can borrow overnight from Citigroup, just say transfer to there. I borrow, I pay you 3%, but for tonight, and this is for reserve. And tomorrow, Fed transfer back if return. You see, Fed do the banking business, but this money, Fed fund rate, it is for borrowing reserve. Very good question, though. You see, that's how you figure out those rate, who's who, why. And that's the whole point. It has so many confusing because you have discount rate. Remember, discount rate is banking, who is a member bank, they can borrow, okay? They borrow from the Fed, this interest rate. Only for, this for, not for market, for the banking, member bank. This is reserve paid on money parking here. And this banking borrow to each other and put in money here. That it is the borrowing reserve rate. So, and then you have you and me, you remember this interest rate is allowed, right? Mortgages, student loan, but this market, different product, different rate. So this is a market rate. So now here argue say, banking, JP Morgan can lending to you, can put the money here. So they're struggling, right? So they will see whoever favor who will lending, but lending to you take a risk. But lending put in here have opportunity cost, right? Because parking here didn't lending to you, they make a less 1%. Imagine the competitor did lending to you, didn't parking money, then they will make a better return on you. You can see this market competitor. But anyway, no matter what it is, opportunity cost, you lose 1% if you put the money. Just this is the choose actor, not the borrowing money. It's a choose actor, and they pay interest. You clear how much, which money is missing? Okay. So based on what we argue, we just got this demand curve downward. See, we got the demand curve of the reserve. Okay, so the Fed fund rate, when Fed fund rate dropping, and then opportunity cost. So this rate got lower. Your opportunity cost holding here. Actually, you know what? It is less and less. So that means what? I can holding more excessive rate in this case, right? See, if the borrowing challenge each dropping lower, and then you have put more money here. So that's why demand curve increased, downward demand curve. Go ahead.
What if the rate is really low? What if the federal funds rate is lower than the reserve rate? What
This one, right?
Yes.
Yeah, this one. Very good.
What will happen to
Okay.
the stock market if the reserve rate is higher than the federal funds rate?
Okay, very good. We will go there right now. Okay. First of all, let's figure out this piece. Okay.
Yeah. Okay.
Look at this piece. Okay. This is reserve. What did he argue? Say what? Very good question. Okay. Remember we say the Fed make decision this interest rate. Okay. And now right now it is Fed fund rate is 3%. Now his question say, what if Fed put this interest rate, let's say it's not 4%, Fed put on 2%. We change this one 2%, okay? 2%. All right. And watching, very good question though, because remove all this two, don't confuse with this one. Okay, look at this market, okay? I know it's messy, but just follow this 2 points. One is JP Morgan, Citigroup, banking, lending, borrow each other is right now 3%. If we put actual money in the excess reserves, only 2%. Okay. Now let's see. If JP Morgan, if Citigroup borrow money from JP Morgan, what do you think? JP Morgan is here, put money is 2%, and JP Morgan will be prefer, or Citigroup also do the same thing, have the 2% and 3% of the Fed fund rate. Let's say, let me reverse, just choose the other direction. If JP Morgan need the money, okay, JP Morgan can borrow money from Citigroup. Also can, this excess reserve pay 2%. Is put there, make money 2%. What the JP Morgan will do? I think I should say is lending, okay, use lending way. JP Morgan lending Citigroup 3%, okay? Or put the money in 2% here.
They're gonna lend.
They will lend, right? Good. Now I changed it too. I changed it the other way is I hope you're not confused because I talked twice. What if this one lower to 1%? Fed fund rate lower below to the reserve 2%.
All the banks are gonna put their money in the reserve rates, in the reserves.
Right. So what happened to, let's say, if the Fed fund rate borrowing each other is 1%?
No one will.
Do you think JP Morgan will lending money to Citigroup?
No.
Okay, good. So that means what happened? If the Fed fund rate, it is 1% here, okay, let me remove out, this is confusing here. So if 1%, okay, this is 1% Fed fund rate right now. It's very important here, right? Okay, if Fed fund rate is 1%, then the required reserve, they pay 2%. Is any banking will lending, the other banking for 1%?
No.
Nobody, right?
Correct.
Nobody. Okay, good. So that means what? So that means nobody will lend in this Fed fund rate. No way going to go to below the excessive reserve. This low level means what happened like this.
Would it be an upward slope? Yeah.
Going to be flat because indefinitely people will be put the money in the excess reserve. So let me redraw this demanding curve. Okay, let me do it one more time. This is not beautiful one. Let's do this one. Okay, so we already got a downward. Then we're gonna see So this is the one vertical. Okay. So the bottom this piece, it is excessive reserve. Okay, it's excessive reserve rate. So we just got the demand curve downward. We say is what if lower below? It means the federal fund rate lower than excessive reserve rate. So we say is no way, impossible. Nobody will gonna happen do that way. So that means definitely this rate won't be reached below. So that means it have to be remove out this piece, stay that won't be this long. We had to go back. Can I go back this rate? Okay, sorry, I cannot go back. Means never below this level. So that means your demanding curve will be very, very ugly demand curve. Okay, let me erase out this one.
What if both rates are the same?
Okay, the same is just like this.
Flat. Okay.
Yes, it means indefinitely. This if this is one is ER. Okay, it says reserve.
Was after before 2008 there was no rule about this, correct?
Yes, there are no.
And
Yeah.
what was it because when 2008 happened, no banks wanted to give their money to another bank?
It's let me tell you what happened before. Before it's like this, okay? So before 2008, they don't have this competition here. They don't pay interest rate on the excessive reserve. Before you require you put it in here, and you want to put excessive reserve, they don't give you interest rate at all. Means they put an actual or nothing. It means they don't give you attractive control money flow. This is before. But 2008, they want to protect a bank. It means they want the banking put more money here to be attractive, and then they give some interest rate. And so that then they control money flow now. They want this money go here a little bit more, protect banking. Remember this cushion for insurance of the banking. But when banking doing this way, banking do not lending. So that's why we have created a crunch. Remember, nobody banking lending to each other. So then you and me cannot get loan, making economy worse. Means we supposed to need the money. That's why we print a lot of money. We don't see anything effect. Remember, you saw the last chapter. So that's the thing is the debate about this interest rate should help. But the Fed control, you will see at the end of this chapter, you see why Fed want to control. There's a whole point about the control. Okay, about the control. This guy. This is Fed fund rate. Okay, remember this whole thing is a Fed fund rate, banking lending to each other. This is a free market. Okay, but the Fed will say no. Fed cannot say, oh, this one should equal 2%. It's not, because it's a market based on daily flow and the supply demanding. So Fed also wanted to control it. So they choose a certain way, delicate way to control it, okay? So at least we derive the demanding of the reserve demanding curve, okay? So that's demanding curve. So we very soon get the supply curve. And then end of this chapter, you will see the flow, means how they control the money supply, okay? So that's a good piece that we done. This is the demanding curve, okay? Now, supply is easy, okay? So let's see. The downward sloping demand curve becoming flat, infinity, because you can no way Fed fund rate below the excessive reserve. No, impossible, because the banking will be just go to the reserve, don't go to the Fed fund, because Fed fund's market. They can go to excessive reserve, pay interest, go there to get an interest rate if lower. So that's why, okay? So for supply, it's easy. Nobody can control money supply, only the Fed, okay? So therefore, you can see when we remember we split the monetary base, one borrowing, one no borrowing, remember? And then so monetary base is controlled by the Fed from the last chapter, remember? So now you can see the Fed fund rate. We just put it there, look at supply, and then we'll talk about flat piece, okay? So supply curve is this piece, okay? The Fed, no borrowing reserve, because Fed put the money there. Because the borrowing reserve is the banking borrow They make decision, but no borrowing reserve. It is the Fed control. Okay, they are monetary base equal to no borrowing plus this one plus the borrowing reserve. But borrowing reserve is a banking make decision, so Fed cannot control. But this piece is Fed control. Okay, so no borrowing reserve. Borrowing reserve, it is the Fed doing that. Okay, it is the banking doing that. Okay, so now watching. If this discount window, remember discount rate is member bank can borrow from the Fed. So this discount rate, okay? This is excess rate, okay? So this demand curve we just did, okay? So this is not OR, it's ER, the typo, okay? So watching. So what happened if Fed fund rate above a discount rate? Let's go by the hour chart. What happened? Okay. So look at this, we still have this one. Okay, let me remove out this thing. Okay, so you see discount rate, okay? And then what do we have? The Fed fund rate is here. Okay, let me do it. Okay, we say is if a Fed fund rate higher than discount rate, what happened? Let me just type in new number. If it is a Fed fund rate, it's 7%. Oh, you know what? Oh yeah, I don't want to choose the 1%. Let me erase out 1%. Okay, what happened? Remember, Fed fund rate is JP Morgan borrowed from Citigroup. If Citigroup market there charge you, Citigroup, 7%. JP Morgan borrow from who?
The Fed.
Exactly. So JP Morgan will go to a discount window indefinitely. Nobody will go to here. So they definitely will go to discount window. Right? You agree?
Yes.
Exactly. So that means impossible. This Fed fund rate will above that because no exist this rate anymore because they go to the Fed fund rate. So indefinitely. So that's why this curve, the supply, this curve of the Fed fund rate becoming indefinitely. So that's the supply curve vertical, horizontal, and this one horizontal. Okay. Once we argue about this supply demanding for the reserve, this curve we derived it, then easy now. From now going forward, very easy. Okay, so all you need to figure out just how to argue about this supply demanding curve. So once we done, good, we figure out the Fed fund rate. Okay, this is the equilibrium of a Fed fund rate. You can see the Fed Fed fund rate lower, they can just put more money here. Okay, put it in vertical here. If they wanted higher Fed fund rate, they put a supply curve in here. So interest rate will going higher on Fed fund rate. Okay, it follow now. Just follow me. Okay, that will be very soon. See how this equilibrium will be different. All right, so at least we know this supply demanding curve. So now see what's happening. So we're gonna change it, right? So how the money changed? Changing in this two money policy. Okay, so we said that it's open market operation. We did that. You remember open margin buy, open margin sell. Open market buy secure. Let me repeat again, okay? So when you purchase, open market purchase means to buy security in the markets, okay? So that's the word of purchasing. Let me ask you, when the Fed, what's motivation they want to buy security? Motivation means what's the Fed purpose?
To inject money into the economy.
Yes, very good. Yes, okay. But what about if open market sell?
Take money out of the economy.
Right, so cool down the economy, right? Good. That's what we're doing. Okay, let's see. So the effect of open and market operation depend on whether the supply curve initially. So what you're trying to say here is depend on initial equilibrium. Okay, if you will see, in the beginning, the market they settle in where, and then Fed policy changed, maybe affect the new equilibrium, maybe not. Okay, so that's why here trying to tell you depends on. That's what I mean. Depends on whether this supply curve initially intersects on the demand curve depend on which area and the cost of this new equilibrium. Okay, let's try to argue that. Okay, so open market purchasing caused the Fed fund rate to fall. Remember, we said open market purchase is buy security. That's the whole point, is inject money supply. Remember when you inject money supply, we say, oh, interest rate fall. Why? You see that? Inject money means here, you offer more no borrowing money. That's what it means. So supply curve, so this one is shifted to right side, and then you can see interest rate will be lower. Okay, new equilibrium. And that's basically, that's what it is, but they use a word to state it that way. Okay, so we will see the very soon about it. This is just to tell you, but later on you see the chart. Okay, you see open market sell, open market sell cause the Fed fund rate rise. So sell is moving this way, reduce. Remember, selling is selling security. So let me go back again and repeat what we have before the flow. Okay, how you flow. Remember, we say in this chapter in the beginning, we said we have a 3 player. Okay, we have 3. Let me do this beginning. Okay, so, and the Fed is a bank of banks. Okay, so they have reserve, you have account here. Okay, so you have banking with your banking. You see? All right. So very, very important is we are the society. Okay, so when they open market buy, see they can buy. Remember, we learned buy from you or buy from the bankings. Okay, but no matter what, if you buy from banking, let's say JP Morgan selling the security back to the Fed. So JP Morgan have more money. Once they have more money, they can lending you, lending to everybody. They have more money to lending, like they can do business. So, but if open market sell, so they sell the security, JP Morgan will have a lot of treasury here. So they don't have that much money. So no, they don't have that much money. Now they will reduce lending. So you and me will have less money. So that means the society have less money floating. Remember when they reduce the monetary base, then reduce the amount, the multiplier, money multiply the base, that's a lot. So there's a whole thing, the flow, you can see open market operation can do both ways, okay? So you need to know which way is, one, the economy is booming, so lending more, bigger, okay? And which way is a shrink, that means that's how they cool down the economy, okay? This is the Fed operating, okay? So that's what the operation is. Okay, so we got this, the supply demanding curve, we say reduce it and then reduce this one. You can see interest rate, Fed fund rate will be higher. If we increase, okay, open market, so they can see that's interest lower. Okay, so now here just saying what do we talk about? Open market operation. So that means didn't tell you buy and sell, okay? Have no effect on Fed fund rate when intersection at flat. You will see, okay, this whole thing they're saying is we already have curve. So it means showing a very good one, okay? So let's see, let me just jump in a couple of curves, let you see. You see, response to open market operation, okay? See, what they argue say here, before the equilibrium, okay? So demanding curve and the supply curve, okay? In the beginning, we have equilibrium, that's the Fed fund rate. In the market is very good, perfect, okay? In equilibrium, settle down. So suddenly, Fed want to change the equilibrium. They want to remember Fed wanted to cut interest rate, Fed fund rate. How they did it? That's what they did, okay? They just put the more money in the economic system. Remember, use open market operation. If they purchase, okay? Purchase means buy security. So put more money, that's what they do. So in that case, you can see supply curve, this is supply curve shift to right. And then you can see Fed fund rate from before equilibrium drop to here. And that's when the Fed fund rate lower. And now you know how they say, oh, we want to make a Fed fund rate cut to, from 1% to, cut of 25 basis point. And that's what I mean. And they figure out if you put how much money, so then they can drop a 25 basis point. Or they can do increase 25 basis point. Either way, they don't have to be choose to 25 basis point, okay? But just they can choose 50 basis point, can to 1%, okay? So that's the whole point is they can do that. They use this money supply, use the operation, okay? So that's the one thing. But they tell you is what is, you see this one, compare this one. So what happened here? They do the same thing, amount of money supply increased. So what happened to the equilibrium? What happened? Anybody?
Shifted to the right.
So Fed fund rate, what happened to Fed fund rate? What happened to Fed fund rate?
Decreased.
Watching the chart, watching this chart.
Oh, stay the same.
Yeah. Yeah, very good, very important here, okay? See, you will see very soon. See, look, before equilibrium in here means what? Means the Fed fund rate equal to excess reserve, pay that interest rate, remember? So equal. So then Fed even put more money in economic system, nothing affect Fed fund rate at all because already in the bottom. So nothing affected, okay? So that's what one thing depends. So you say open market operation will affect the interest rate, interest lower. Not true. It depends where we were. So we were here. It's different story. Okay. So this chart is very good. The chart just tell you the story, whether you are, supposed to be this word trying to tell you. Okay. So that's good. That's what it tell you interception way. Let's do next chart. See what happened to change in discount rate. So discount rate watching. So if a Fed want to drop discount rate, okay, before discount rate is here, so supply curve. So what happened here? What's the equilibrium? In the first chart, what happened? What happened to the Fed fund rate?
It stays unchanged.
Yep, very good. Because what happened is the Fed have to know, say, if they do, drop the discount rate, do they gonna affect the Fed fund rate or not? So now in this case, if equilibrium in the downward sloping of the demanding curve of the reserve, nothing affected. However, it's here. Look. So before the interception, demanding curve, and but the intercepted with the supply curve in horizontal that piece. So when the Fed wanted to decrease the discount rate, look at the Fed fund rate, it dropped. You can see Fed know where to adjust the discount rate and where to adjust this equilibrium because they know they have to figure out what's the beginning of this equilibrium. So in this case, it is dropped, but in this case, nothing affect. Same action, drop discount rate, but it's different story, okay? So that's what give you some reasoning about why the response of this actions, the change didn't affect the Fed fund rate. Now let's do this one. I want you to tell me what happened and why. Anybody can think of a required reserve.
Yeah.
Go ahead.
So when the required reserve when the requirement is increased,
Mm-hmm.
I mean there's automatically some money taken out of the system because more
Mm-hmm.
money will be deposited in reserves.
Mm-hmm.
And I think that might affect the flow of transactions occurring between banks.
Mm-hmm.
So less transactions would lead to a higher rate, and that's why the federal funds rate would rise.
Mm-hmm. Well, the curve shift is showing you that the Fed fund rate increase, right? Yeah, very good. But however, remember, he did a good job. Okay, it's you see, require reserve. Remember, reserve in this case is increase. So if the Fed require, let's require reserve ratio. So required reserve will be increased. So if increase, remember this chart, you can just do the same thing, okay? So if required reserve ratio increase, that means the banking need to put more reserve in here. So that means demanding reserve increase, right? You agree? So that's why demanding shift to right side, to here, to right side. This is a vertical, okay? So this is supply. So demanding, because this increased. See, everybody had to put more money in here because then the JP Morgan, all the banking demanding more money for the reserve. So you can see the banker shift. So before here, equilibrium interest rate, Fed fund rate now increased. So that means what? Because Fed want the banking put more money, then interest rate, Fed fund rate, you can see increased. This is Fed fund rate. Okay, this is Fed fund rate before. So this is the second one, second Fed fund rate. So increase, this is upward. Why? Because they want more money in here, not the money lending to you. So that's how they can, they influence this money from the banking absorb in here, control this way, and then banking lending to each other becoming expensive because banking prefer parking here. All right. So that's why I can see the same logic come back here. If a required reserve increased, a lot of banking have to put money there. So that's why demanding for the reserve increased. Okay. Once result, you don't need to know where, but once you draw the chart, you immediately find out the Fed fund rate going to increase. So that see, Fed can use another way to increase on the Fed fund rate. See, Fed fund rate is not bank, it's not Fed say it's 2%, 3% like a discount rate, but they can influence, they can impact, use that monetary policy or tool impact on this free market lending borrowing. Yeah, you can say that's a word, but that's negative. It is manipulated, okay? It's a whole thing manipulated. But that's why, young people like you guys just believe Bitcoins, right? Because that's the whole point, thinking why they manipulate it. But, once we talk about Bitcoins, you see the Fed say, answer the question when they get after open market committee meeting, they mentioned that. They say is, they want to control. They think about digital money, but they want to control because they believe the dollar is still in our favor right now, and they don't want anybody else take over dollar power. So if we do the Bitcoins, we do everything else, our country just don't have favor anymore because everything right now still settlement currency is dollar. So that's why we do not want to go to anywhere else, means Bitcoins, whatever, because you're out of control.
Oh,
But
China was actually thinking about doing a digital currency, and they were gonna
right,
take a 1 yuan out of
yeah,
circulation whenever there's a
yeah.
digital yuan.
Right, but you remember, yes, very good point. Okay, China just feel they want to come in compete, right? Because they know over those since World War II, our country is so rich right now. Although we borrow money, but our dollar is the world oil settlement currency. Okay, so becoming very, very important. And this all those decades we favor a dollar benefit for us. So China right now want to compete, but remember the Fed just last time is a conference, Fed format committee after the decision of the Fed fund rate, and then the chairman come out to say that he said that people ask the question, say just say what do you say about the other country competed the currency, and he say is yeah they do, but take time, because remember whole world if a settlement in dollar, that means if you right now slowly settlement in other country currency, but this is just like habits. If they all accept dollar, very rarely accept something else. Market just take a time to overall to take over the other currency. That's why they very confident. Fed very confident say, don't worry, you don't know how long going to take it to accept another currency. It means our dollar still dominated of the whole world. Any corner accept this our currency as a settlement, right? But now you know what happened is this Bitcoins, this is the cryptocurrency right now. You see, no way you stop it. So every day more company accept it. More, we do not know where to go. So if one day this is becoming the trend or momentum becoming this currency, maybe our dollar maybe not able to sustain this way, say, oh, we are still in the settlement currency. But what if, like I said, if every corporation want to, even Tesla right now want to accept some Bitcoins as a currency, reserve it, because what if you had customers say, I want to buy a car, I want to use my Bitcoins, right? So that's why all corporations thinking right now.
Actually,
so we do not know.
Professor, I want to add, you said that Tesla is accepting it as a currency. They're not really accepting it as currency. They're just accepting it as like
They're not yet.
a barter,
Mhm.
as barter.
Yeah. Right.
Because it's valued in dollars, not valued in Bitcoin. So they're accepting it, the value of Bitcoin in dollars, and then it's changed from the dollar price to Bitcoin. So it's not a set
not yet.
Bitcoin.
Yeah.
So it's not really, yeah, it's just barter.
Yes, you know why they do that? Because that's what I said.
It's too volatile.
Right, not ready directly yet. Everybody, corporation want to have some Bitcoins. They worry about it in the future. What if in the future you have the customer when you're ready to settle with the Bitcoins? Right now, like I say, it's transition moment, but everybody want to touch a little bit. But we also do not know where this is going to go, because each country, they all say no. You can see, you just mentioned about this, okay, we can see manipulation of this money supply, this whole thing, because government want to control currency. Every country want to. So nobody really wanted to replace their own currency. So digital currency is still dollar, like the Fed mentioned that. We means our Fed is considered digital way of a dollar, digital dollar. It is considering. But so that means not like not another currency, but digital dollar. They consider it, but that's the same thing, transaction, everything convenient, but doesn't mean it have to be another Bitcoin, that kind of currency. So it's all is evolutionary right now. Okay, we do not know. So we do not know in the future will be killed all thing, or maybe just continue like people buy, just like a reserve something. Some people even say, you know, Bitcoin is hiding the oil or hiding the current inflation. Who knows? Because you never know what's going to happen. Right now, it's just chaos in the environment. Like the Wild West, eventually we'll find out the trend where they go. Right now, just people, that's why people are betting on all kind of currencies right now. Because a lot of currency right now, a lot of digital. Yeah, go ahead.
Do you think the Fed will hike rates in next year?
They can't.
What do you mean?
The Dallas Fed was saying something like the Fed should hike rates in 2022 or 2023 because of inflation, because of asset prices and inflation. And Yellen said today the Fed may also need to do it because of Biden's infrastructure plan.
I think the Fed mentioned that they said they'll start to think about raising interest rates, which means that they haven't even thought about the idea of starting to think.
Yeah, but the Dallas Fed said 2 days ago or last week that they should because of asset prices and possible inflation. So yeah.
Very good debate. Okay, very good debate. It's true. In fact, right now themselves don't even know. They said trajectory. Remember, you guys said that this inflation may be short. Trajectory means like they could be short term, just for now, pop of the inflation, and then later on will be fading. That's they hoping and they target on that way. Now a lot of economists don't believe it, maybe not. That's the whole point. Right now, who know? Nobody know whether this inflation, it is trajectory or it is becoming cannot control. Why? Because what happened, you said, you see that you guys talking already touched two way. One is the Fed. The Fed only can control monetary policy, okay? Then you have government there printing trillion. Did you see keep a proposal more trillion? That's a physical policy. So if a physical policy, monetary policy working same way to print money, you do the math about how much money in the economy.
Isn't that hyperinflation then when both fiscal and
that will be terrible. Yes, that will be terrible. So Fed is said like this way. Remember we said Fed is independent, and the Fed is trying to do this way. Said we're monitoring. We will see what the physical policy turn out. But physical policy don't even care about the monetary policy because they don't care. Okay, they just do what they want. They want 2 trillion and put trillion. Now Fed had to do the homework. Say okay, if really 2 trillion, and then what are we gonna do? And then that's why Fed right now is happy is, okay, we want to have some inflation. Now we saw it, okay? Remember we mentioned last time, say, we already see first quarter already 4.1% inflation. So it's there, we saw it. And today, Yellen even mentioned, say, yes, we know we have some inflation. So sounds like they're okay for now. But key point is, whether this inflation will be persistent. Even persistent, you know that it's the inflation, okay? That's terrible.
But I feel like if it is persistent, then they already let the inflation genie out of the bottle. You know?
Yeah.
And then like there's a saying not to do that. You don't.
Well, they might do the Volcker shock 2.0 where they just raise interest rates by a lot.
Yeah, then that would kill the housing market, then that would create
right. That's what they did in 2008, right? So they just waiting for bubble all the way to the bubble to the point they say, okay, we got to do something. And then they do very fast. They do boom, 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 from 0 all the way to 3.2%, 3.5% of Fed fund. Remember, Fed fund is the bottom of the interest rate. And then market killed because all those arm, remember, adjust rate mortgage, you get in trouble. So yeah, so whole point is we do not know. That's why you see market very panic. Yelling this morning said something, you see market tank a lot, and then later on come back a little bit. Market right now very emotional because they worry this money, those much money in this system. We never see this strong market. Even we haven't full opening yet. And also you see the Michigan Confidence Index, we never have that high. We normally 51, 60, right now 80 something. That means very, very strong economy. And then meanwhile, you tell people we are strong, everybody's so, pretty much confident, happy on the economy, open up. And then we still haven't finished printing money yet. We haven't done those 1.9 trillion, haven't come in yet. So that's what many people are worried. So that's the whole point you say manipulated. That's what the point why created on those other currencies purpose. But beyond have more story. You see more currencies come out of the digital crypto and also monetary. You see European haven't opened yet. So imagine global if open up, global printing also. Why global? Because everybody want to open up the business, okay? We all short of product right now. Because everybody opening, but the market have a factory have opened up yet. So you will see this slowly booming up. We are dynamic economy, then overheat if we do not know. Fed was thinking, see the tool, we have so many monetary policy tools. Fed believe we have enough too. We know how to fight on inflation. Okay, that's what they believe too. So we will see. Okay, but you're watching very good. I can tell you guys monitoring Fed action is good for your own personal investment because that's the whole point. Market follow the Fed what they're doing. Remember we said never fighting with the Fed Your Fed want the money put in the system, lower interest rate, the interest definitely low. You cannot fighting with them. So you had to watch them, make a decision. Okay, so very good. Continue monitor them. So we stop here. We talk about next time. Okay, so we, like I said, only one chapter left. So very easy. Any question?
So after we finish this chapter, what are we doing?
Nothing. We just review. We do a review, and then it's becoming a reading week. So it's good because then you have more time to do.